While the two biggest cryptocurrencies, Bitcoin and Ethereum, reached their all-time high during late 2021, their price along with all cryptos plummeted to reach 20k and 1.5k for Bitcoin and Ethereum respectively. Whether you are a crypto miner, staker or holder, here is what you need to know. Hi, Jared here, and today let's talk about cryptos. So, in this video, we'll talk about why this crash is different, the ups and downs, why stable coins are not really stable, and if you should buy the dip or not. The 2017 crash was largely due to the burst of a hype bubble, but the current crash began earlier this year as a result of macroeconomic factors, including uncontrolled inflation that has caused the US Federal Reserve and other central banks to hike interest rates, and these factors were not present in the last cycle. Bitcoin and the cryptocurrency market more broadly have been trading in a closely correlated fashion to other risk assets, and in particular, stocks. Bitcoin posted its worst quarter in more than a decade in the second quarter of this year. In the same period, the tech-heavy Nasdaq fell more than 22%. See the correlation here. That sharp reversal of the market caught many industries, including cryptocurrencies, stocks, and even real estate. Bitcoin and Ethereum are down more than 50% from their all-time highs in late 2021. But while there have been small surges in recent weeks, the crypto market as a whole is largely stalled. And even in 2021 alone, Bitcoin hits multiple all-time highs and then big drops. Then even more institutional buying from big companies like MicroStrategy and even El Salvador. Ethereum also hit new all-time highs in late 2021, then big drops, and then it crashed below $900. Moreover, US governments and the Biden administration have increasingly expressed interest in new regulation of the crypto industry. All the while, people's interest in crypto remains high, even really high. It's a hot topic not only among investors but in popular culture too, thanks to everyone from long-standing investors like Elon Musk to that kid from your school on Facebook. It is now time to talk about stablecoins. I mean, just coins, because some people believe that investing in stable coins would allow them to ride the cryptocurrency roller coaster while minimizing wild drops. The idea behind stable coins is that their value should remain constant. They are marketed as less risky than investing in other cryptocurrencies such as Bitcoin and Ethereum. When Terra, also known as UST, imploded, that promise of stability was broken. It was intended to keep its $1 value, but it didn't work, not by any means. It should have been 1-to-1, when in fact it was 1-to-0. We also have Ether, the world's most popular stablecoin, which fell below its $1 price in May. People distraught and surprised by the spectacular losses after betting big on Terra can be found posting on Reddit, Twitter, and YouTube, everywhere on the internet. Stablecoins seek to maintain their peg or stability through algorithms that increase or decrease account supply in response to changes in demand. So basically, once you buy a stablecoin, their supply will decrease just to keep that $1 value. These algorithmic coins have been at the center of controversy following the crash of US Terra and associated cryptocurrency Luna USD in May, where an estimated $42 billion of investment was lost in 1 week alone. Okay then, high yields also means high risks. Celsius, a company that offered users yields of more than 80% for depositing their crypto with the firm, paused withdrawals for customers last month. Celsius acted sort of like a bank. It would take the deposited crypto and lend it out to other players at high yield. Those other players would use it for trading, and the profit Celsius made from the yields would be used to pay back investors who deposited crypto. But when the downturn hit, the business model was put to a test. Celsius continues to face liquidity issues and has to pause withdrawals to effectively stop the crypto version of bank run. So, who is hurt? And first, are exchanges okay? And they better be, because they hold our coins. Even established players like Coinbase have been impacted by declining markets. Last month, Coinbase has laid off 18% of its employees to cut down on costs. The US crypto exchange has seen trading volumes collapse lately in tandem with falling digital currency prices. We have also seen examples of potential stress where miners have allegedly not paid their electricity bills, potentially alluding to cash flow issues. Because when mining is not profitable anymore, how do you pay electricity bills? This is likely why we are seeing some miners sell their holdings and even components. Role played by miners comes at a heavy cost, not just for the gear itself, but also for continuous flow of electricity needed to keep their machines running around the clock. And keep in mind one thing, that the more miners we have on the network, the better, because the more secure it becomes. So, should you buy the dip or not? Because when buying the dip, crypto investors should proceed with extreme caution. Here is why. When asset prices decline as rapidly as they have on the crypto market today, it can make that coin you have had your eyes on look like a super deal, right? Because when Bitcoin is at 20k and you wanted Bitcoin at 25k, then you will buy Bitcoin. But as investors have a rule of thumb to describe that moment, never try to catch a falling knife. And using your imagination, you should probably understand that trying to catch a falling knife, aka buying the dip, always ends painfully. That is not to say that skillful investors cannot make a quick buck trading on heightened market volatility, but point here is that big, fast market moves can be unsettling for the typical retail investors. So, what to watch now? Because the Ethereum merge will likely be the biggest potential crypto market moving catalyst in November, October, November, and so on. However, investors will also be watching several other key events as well. The US Securities and Exchange Commission, or SEC, once again delayed its decision to launch a spot Bitcoin ETF, pushing back its decision deadline from August 27 to October 11. And you probably know what an ETF is, and if you do, you know how important this decision about the SEC is for the crypto industry. Because if Bitcoin becomes an ETF, then it will become available for millions of investors across the world. What do you think about the current situation of cryptos? Are you more bullish or bearish? What are your thoughts on that? Thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and I will see you in the next one.